Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Absolutely.
Because today we're looking at this really fascinating question. Like, what if the very things you're buying to look rich are actually mathematically guaranteeing that you stay poor?
Right. It's a huge trap.
It really is. It's so easy to fall into, especially when you start making a little bit of money. So in this deep dive, we're going to unpack the critical difference between spending money to just project an image of wealth versus actually allocating your capital to be rich.
Yeah, and I think it's perhaps the ultimate modern financial illusion, honestly.
Oh, for sure.
The traditional markers we associate with success in our culture,
Yeah.
the luxury vehicles, the designer bags, the limited edition watches.
A stuff everyone wants.
Right, exactly. But according to recent analysis, those are functioning as the exact roadblocks preventing everyday people from accumulating real assets. When you look at the underlying math of these purchases, you quickly realize that building the appearance of wealth is, well, it's fundamentally at odds with building actual wealth.
Exactly. And just to be super clear to you listening right now, our goal today isn't to give you some, preachy lecture about skipping your morning coffee
No, not at all.
or telling you to live like a monk.
Hmm.
We really want to expose the hidden mechanics of wealth based on global economic data. We're going to show you how financing an aspirational lifestyle is basically just funding the compounding wealth of massive corporations.
Which is a wild realization when it hits you.
It is. And we'll break down exactly how you can take that financial power back. So let's just get right into it. Where do we start?
Well, to understand how this works, we need to look at what happens at the individual level first, long before we zoom out to the broader macroeconomic picture.
Okay, makes sense.
According to recent behavioral research we've been looking at, conspicuous consumption, which is just the academic term for buying expensive things, primarily to signal your status to others, it forces this really dangerous trade-off.
Right, like buying the shiny new things that people think you're doing well.
Exactly. You're exchanging your future cash flow for a present-day image. And you're doing it by purchasing heavily depreciating assets.
Okay, let's unpack this for a second because I think we need a really clear mental model for what a depreciating asset actually looks like in practice. The numbers can get kind of abstract.
They definitely can.
So imagine you buy a luxury car purely to impress your neighbors. Buying that car is basically like buying a giant, meticulously carved ice sculpture for your front yard.
That's a great way to look at it.
Right, because it looks absolutely spectacular on day one. Everyone driving by is super impressed. But the second you put it on the lawn, it starts melting.
Yep, immediately.
Every single day, regardless of what you do, it's shrinking. It's literally taking the money you spent on it down the drain. It doesn't hold its value, let alone grow it.
That analogy perfectly illustrates the concept, but the situation is actually a bit more severe when you factor in the financial principle of opportunity cost.
Oh, right, because it's not just the money you spent.
Exactly. The price tag on that melting ice sculpture or that luxury vehicle does not represent the true cost of the purchase.
How so?
Well, if you spend $10,000 on a designer watch, you might think, you're simply down 10 grand. But the true hidden cost is the 10 to 20 years of compounding interest that capital could have generated for you if it had been put to work in the markets.
Right, right. Let's expand on that idea of putting capital to work, because I always like to think of every dollar you earn as a tiny employee.
I love that framing.
Yeah, so if you have $10,000, you have an army of 10,000 workers. When you hand them over to a luxury boutique, you're essentially firing your entire army.
They're gone.
They no longer work for you. They now work for the shareholders of that brand. But if you invest them, they stay on your payroll.
And not only do they stay on your payroll, they actually recruit more workers for you.
Yes.
If you place those 10,000 workers into a diversified investment like an ETF or bonds, they generate returns. Let's say they earn a modest historical return. Next year, you don't just have your original 10,000 workers, you have 10,700 workers.
Because they made you money while you were sleeping.
Exactly. And the year after that, those new workers also start recruiting. Over a decade or two, that initial $10,000 could have become $30,000 or $40,000.
Wow.
So when you buy the watch, you didn't just lose $10,000, you destroyed the $40,000 that money was mathematically destined to become.
You're systematically robbing your future self just to impress strangers today. It's crazy when you put it like that. And looking at the data, this trap becomes particularly dangerous when people experience a bump in their salary, right?
Oh, absolutely.
Because there's this psychological phenomenon called lifestyle inflation, and it just kicks in almost automatically for most people.
It's incredibly common. As income rises, people subconsciously feel an obligation to, like, upgrade their baseline existence.
Right. You get a promotion, so you immediately move into a luxury apartment building.
Yep. Or you get an end-of-year bonus, so you lease a more expensive car. You start taking costlier vacations.
You feel like you earned it.
Exactly. You feel like you deserve it. But instead of taking that new surplus of money and upgrading their investments, they upgrade their consumption.
Right.
And what they're actually doing is building a highly fragile financial structure. They look much richer on the outside, but because their mandatory fixed monthly costs are now so high, they're financially far more vulnerable than they were before they got the raise.
Because if the economy turns and they lose that high-paying job, the ice sculptures on the lawn keep melting. The expensive leases still need to be paid, but the income funding the whole charade has just vanished. And I think this brings us directly into the macroeconomic reality check of our current environment. Because looking at the data for the current economic landscape right now in May 2026, under President Trump's administration, borrowing money to fund this aspirational lifestyle has become mathematically punishing.
It really has. The cost of borrowing has fundamentally shifted compared to the previous decade.
Right.
If we look at the global bond markets recently, we've seen significant sell-offs, and that pressure has pushed the benchmark U.S. 10-year Treasury yield up to around 4.68% and the 30-year yield up to 5.18%.
Okay, wait, let's break down the mechanics of that for a second. Because if I'm just an average person walking into a car dealership this weekend to buy a vehicle, I probably don't care what a 10-year Treasury yield is doing in Washington or Wall Street.
Right. It sounds like financial jargon.
Exactly.
Yeah.
So how exactly does that bond yield dictate the reality of my personal bank account?
So the 10-year Treasury yield basically acts as the baseline floor for the cost of credit across the entire global economy. The United States government is considered the safest borrower in the world. If the U.S. government has to pay investors 4.68% interest just to borrow money, a private bank that is taking a risk on lending money to you needs to charge significantly more than that to make a profit and cover their risks.
That makes sense. They have to beat the safest return.
Exactly. They layer on their operational costs, inflation expectations, and their profit margins. So when that Treasury baseline goes up, the cost of credit everywhere surges.
And we are definitely seeing that.
Oh, absolutely. According to a recent May 20th, 2026 report we reviewed, U.S. 30-year mortgage rates are sitting around 6.75%, and auto loans have reached a blistering 9.45%.
9.45% on a depreciating asset. I mean, you are paying nearly 10% annual interest on a machine that is actively losing its value every time the odometer rolls over.
It's a double hit. And because of those elevated interest rates, combined with the rising sticker prices of the vehicles themselves, the data shows that the average monthly auto payment in the U.S. has reached a staggering $757.
$757 a month.
Right.
Just for a car.
Yes. That is a massive chunk of potential wealth-building capital bleeding out of a household budget every single month, purely for transportation.
I do want to challenge the premise here just a bit, though.
Sure.
Because when we look at all this debt being accumulated, are people really just voluntarily borrowing money to buy designer goods and luxury SUVs?
Whoa.
Because inflation over the last few years has been notoriously brutal. Groceries are expensive, rent is high, utilities are way up. Isn't it possible that people are relying on credit just because their paychecks simply can't keep up with the basic cost of living?
That's a really fair point, and you're highlighting a crucial distinction in the data. You are absolutely correct that the cost of living has outpaced wage growth for many households.
Yeah, it's been tough for a lot of people.
Right, and a significant portion of current debt is absolutely born of necessity, covering groceries, medical bills, basic housing.
Which is just heartbreaking.
It is. In fact, the recent May 2026 New York Fed report shows that student loan delinquencies have returned to pre-pandemic levels, which clearly indicates everyday people are feeling a severe financial squeeze.
Right.
However, our focus today is on the specific subset of debt used for conspicuous consumption.
Ah, I see.
Using high-interest credit to survive is a systemic tragedy, but using high-interest credit to maintain an aspirational luxury lifestyle that is self-inflicted financial ruin.
That's a really powerful distinction. And to put some numbers to that ruin, recent reports indicate that late 2025 U.S. unsecured loan balances hit a record $276 billion.
That's a staggering figure.
It is. And for anyone listening who might not know, an unsecured loan basically means the bank has no collateral to repossess. It's not like a mortgage tied to a house or an auto loan tied to a car.
Right, they can't take back a vacation you already went on.
Exactly. It's a personal loan backed by nothing but your promise to pay, which means the interest rates are astronomical. And furthermore, total credit card debt has climbed to $1.15 trillion.
And if we look at international data, we see this isn't isolated to the United States either.
Really?
Yeah, South Korea's household credit neared a record 1,993 trillion won in the first quarter of 2026. This debt squeeze is a global reality.
Wow.
When you have an environment where basic survival necessities are already incredibly expensive, and you voluntarily layer on the heavy fixed costs of an $800 car payment and 20% interest on a credit card used for designer clothes, I mean, your ability to build wealth drops to absolute zero.
You literally lock yourself in a financial cage.
You do.
Which naturally leads to this really fascinating paradox we found in the data. Because if middle-class consumers are drowning under 9% auto loans and 20% credit card rates to afford all these status symbols, what is happening on the other side of the cash register?
It's an interesting question.
Like, the corporations selling the luxury goods must be having a historic boom.
Right.
They must be swimming in cash.
You would assume so, but the reality is actually quite different. Recent analysis by Bain and Altagamma on the global luxury market forecasts only a sluggish 3 to 5% recovery in 2026.
Wait, really? A 3 to 5% recovery? Why is the growth so sluggish if everyone is supposedly so desperate to look wealthy?
Because the luxury brands severely miscalculated the breaking point of their customers.
Oh, interesting.
Yeah. Over the last few years, these brands initiated aggressive, repeated price hikes. A handbag that cost $2,000 a few years ago was suddenly priced at $3,500.
Just massive jumps.
Exactly. They did this to increase their profit margins and to artificially enforce this aura of extreme exclusivity.
Right.
But by pushing those prices so high, they fundamentally alienated their young, aspirational, and middle-class consumers, the very people who were previously willing to stretch their credit limits to buy these items.
So the people who were financing the illusion of wealth finally hit a hard wall. The math simply stopped working for them.
Precisely. Those aspirational consumers are completely tapped out. As a result, we are seeing massive inventory burdens piling up for these luxury companies.
They just have warehouses full of bags nobody can afford anymore.
Exactly. The pricing strategy has severely backfired in terms of retaining that younger demographic. Recently, at a major Business of Luxury summit, the CEO of Saint Laurent openly warned that brands are going to have to work much harder to retain this weakening aspirational customer base.
Wow. You know, this highlights the ultimate irony for anyone listening who might be tempted to stretch their budget for a status symbol.
It really does.
When you finance a luxury bag or an expensive car, you are voluntarily taking your hard-earned cash and using it to generate revenue for a massive global conglomerate. The truly wealthy person, the individual whose lifestyle you might be trying to emulate by buying the brand they're operating with a completely different playbook.
They absolutely are.
They aren't standing in line at the boutique. They are logging into their brokerage accounts and buying the stock of the companies that own these brands, like LVMH, Hermes, or Richemont.
And that shift in mindset from being a consumer of products to being an owner of assets is the defining characteristic of true wealth. Wealthy individuals allocate their capital to buy shares of companies that possess incredible pricing power and recurring revenue streams. When you buy equity in a company, you own a tiny slice of its future profits.
So you're positioning yourself to be the one collecting the dividends from the company's profits, rather than being the consumer paying the 20% credit card interest to fund those profits.
Exactly.
It completely changes how you view a price tag. Before making a major purchase, you have to look at the item and ask, is buying this enriching my own family's future, or am I just enriching the anonymous shareholders of this corporation?
That is the exact question that separates the wealthy from those who merely look wealthy.
I love that.
So, having diagnosed the mechanics of the trap, we really need to transition into the practical playbook. Like, how do everyday people actively apply this knowledge to build real economic independence?
Yes, let's get into the actionable steps. Because the core philosophy we found in the research heavily aligns with the millionaire next door mindset.
Right, the classic study.
Yeah, that classic analysis of American wealth. revealed that the vast majority of actual millionaires do not drive flashy vehicles or wear conspicuous designer
I
labels.
really don't.
They intentionally keep their consumption levels very low relative to their income. And they do this because they understand that the primary purpose of wealth is not to buy material stuff.
No.
The primary purpose of wealth is to buy options.
The concept of buying options is vital to understand here. And we aren't talking about stock market derivatives.
Right.
We're talking about life choices. Having low fixed costs and a compounding investment portfolio buys you the freedom to make decisions entirely on your own terms.
Which is huge.
It's everything. It gives you the option to walk away from a toxic work environment without facing immediate financial ruin. It gives you the option to take 6 months to find a career you actually love, rather than accepting the first job offer out of sheer desperation because you have to pay your car lease.
Yeah.
It even gives you the option to purchase valuable assets at a steep discount during an economic downturn because you have liquid cash available while everyone else is scrambling to service their consumer debt.
Freedom of choice is the ultimate luxury.
Perfectly said.
So, step one of the playbook based on the data. Cut your structural fixed costs aggressively. And we are not talking about agonizing over a $5 coffee purchase.
Right, the coffee isn't the problem.
Exactly. We are talking about the massive leaks in your monthly cash flow. Let's look at the car example again. If you live in a dense major city with reliable public transportation like New York, London, or Seoul, owning an expensive vehicle is an absolute wealth destroyer.
The math on city car ownership is just staggering. You aren't just absorbing that $757 average monthly loan payment. You are paying exorbitant insurance premiums for a high-risk urban area.
Oh yeah, insurance is wild.
Plus, monthly parking garage fees that can literally rival a rent payment, fuel, routine maintenance, and absorbing rapid depreciation from city wear and tear.
It's a money pit.
It is. If a vehicle is not an absolute non-negotiable necessity for your daily livelihood, it ceases to be a tool. It becomes a relentless consumption machine that actively devours the capital you should be investing.
And the real danger is the inflexible nature of the expense, right?
That's true.
Well, if money gets tight, you can choose to stop eating at restaurants immediately. You just stop going.
Yeah.
But you cannot choose to stop paying your $800 auto loan. High fixed costs strip away your financial agility.
That's a really crucial point.
Which brings us to step two, the invest first rule. The data strongly suggests automating 10 to 20% of your paycheck directly into investments like an ETF or a retirement account the very morning after your paycheck clears.
Automation is the critical mechanism here. The vast majority of people utilize what we could call the leftover strategy.
Oh, I've definitely been guilty of that.
We all have. They pay their rent, they pay their bills, they buy the things they want throughout the month, and they promise themselves they will invest whatever money happens to be left over at the end.
Right. But there's never anything left over.
Exactly. Human psychology, combined with modern marketing, guarantees there is rarely anything left over. Parkinson's law states that work expands to fill the time allotted. Well, expenses naturally expand to consume all available income.
Yeah, that makes so much sense. And just for listeners who might be newer to investing, when we mention an ETF, an exchange-traded fund, we're basically talking about buying a prepackaged basket of hundreds of different stocks.
Right.
So you don't have to stress about picking the next Apple or Amazon. You're just buying a tiny, diversified slice of the broader market all at once, which spreads out your risk.
Precisely. And by automating that purchase before you ever see the money in your checking account, you artificially constrain your ability to consume. You force yourself to adapt to living on less.
Out of sight, out of mind.
Exactly. The wealth building happens quietly in the background, completely divorced from your daily willpower or your emotional impulses to spend.
Think of it like this. You need to treat your own investment account like the ultimate non-negotiable VIP subscription service.
I like that.
You wouldn't dream of letting your essential utility bills or your Netflix subscription lapse, right? Yet people cancel on their own financial futures constantly.
Every day.
You have to pay yourself first. Before the auto lender extracts their cut, before the credit card company takes their high-interest pound of flesh, and long before the luxury boutique gets a single dollar, you pay the VIP, which is your future self.
That framing highlights a profound realization about this entire topic, I think. Strategic frugality is not about suffering. It is not about aggressively denying yourself joy or living a miserable life. It is simply a highly effective capital allocation strategy.
Yep.
You are consciously choosing to allocate your finite resources toward purchasing long-term freedom, rather than purchasing the fleeting appearance of status.
Exactly.
It requires asking yourself one foundational question before any major transaction. Is this purchase going to legitimately increase my net worth, or is it merely going to change how strangers view me?
Is this going to increase my net worth or just change how strangers view me? If the answer is the latter, you are just buying another melting ice sculpture.
Yep.
And in our current economic reality where borrowing money is incredibly expensive and the margin for error is razor thin, financing ice sculptures on credit is a mathematical guarantee of financial stress.
The cost of faking wealth has literally never been higher. The interest rates simply do not forgive mistakes the way they did a decade ago.
Absolutely. Which brings me to a final provocative thought I want to leave you with today, something for you to mull over after you take your headphones off.
Okay, let's hear it.
We spend so much cultural energy obsessing over visible status symbols, the luxury cars, the heavy watches, the designer labels. But what if the most powerful elite status symbol in today's unpredictable economy isn't something you can wear, drive, or post on social media? What if the ultimate status symbol is entirely invisible?
Ah, the concept of financial invisibility.
Exactly. The absolute ultimate flex in 2026 might just be having zero consumer debt, zero stressful monthly payments, and a silently compounding investment portfolio that absolutely nobody knows about.
That's a great thought.
Think about the profound peace of mind that kind of invisibility brings. It grants you the total freedom to step back, smile, and completely ignore the intense economic anxiety that everyone else is so loudly projecting through their expensive melting ice sculptures. You get to walk through life with the quiet confidence of someone who actually owns their own time.
Because real wealth doesn't need to shout for attention, it just quietly compounds.
True wealth quietly compounds. I love that. Well, that is all the time we have for today's deep dive into the mechanics of spending and wealth. Don't forget to subscribe and hit that like button. We'll catch you on the next one.